If Warren Buffett, arguably the greatest investor who has ever lived, told his own wife to put almost all of her inheritance into just one single investment, wouldn't you want to know what that investment is? It's not a secret stock. It's not crypto. It's something called the S&P 500. Here's a number that should stop you in your tracks. If you invest just $100 a month into the S&P 500 starting at age 25, and it grows at its historical average of 10% per year, you would have over $1 million by age 65. Not from picking winning stocks, not from timing the market, just from owning this one thing. If you've heard the term S&P 500 100 times, but never actually understood what it means, you're definitely not alone. Is it a stock, a company, or something risky only professionals should touch? By the end of this video, all of that confusion disappears completely. By the end of this video, you'll understand exactly what the S&P 500 is, how it's calculated, why Warren Buffett recommends it above almost every other investment, and the exact steps to start investing in it today, even with just $10. I genuinely believe this might be one of the most important videos on this entire channel. Everything else we discuss, real estate, side hustles, advanced tax strategies, all of it sits on top of this foundation. Understanding the S&P 500 is investing 101, and most Americans skip straight past it. Let's start with the basics. S&P 500 stands for Standard & Poor's 500. It is simply a list of the 500 largest publicly traded companies in the United States, selected and tracked by a company called S&P Global. Think of it as a scoreboard for the biggest, most successful businesses in America. These 500 companies span every major sector of the American economy: technology giants, healthcare leaders, banks, retailers, energy companies, industrial manufacturers. When you invest in the S&P 500, you're not betting on one industry. You're betting on the entire American economy performing well over time. Here's the key concept that makes this so powerful. When you buy an S&P 500 index fund, you're not choosing between Apple or Microsoft or Amazon. You automatically own a small proportional piece of all 500 companies simultaneously in a single purchase, one transaction. Instant diversification across the entire economy. Who decides which 500 companies make the list? A committee at S&P Global reviews companies against specific criteria. They must be US-based, have a market value of at least $18 billion, be profitable, and have enough publicly available shares. Companies get added and removed over time as they grow, shrink, or get acquired. Here's something powerful most people don't realize. The S&P 500 is constantly evolving. Weak or declining companies get removed. Strong, growing companies get added. This means you're always invested in a rotating group of the strongest American businesses without ever having to make that decision yourself. The index isn't weighted equally. It's what's called market cap weighted, meaning larger companies have a bigger impact on the index's overall performance. Right now, the 5 biggest companies in the S&P 500 make up around 25% of the entire index's value. When Apple or Microsoft has a great quarter, it moves the whole index more than a smaller company would. Important clarification: the S&P 500 itself is just a number, a scoreboard. You cannot buy the S&P 500 directly. What you actually buy are index funds or ETFs that are specifically designed to track and mirror the performance of that scoreboard. The most popular ones have ticker symbols like VOO, SPY, and IVV. The 3 most popular ways to invest in the S&P 500 are VOO from Vanguard, SPY from State Street, and IVV from BlackRock. They all track the exact same 500 companies. The main difference is the expense ratio, the tiny annual fee charged to manage the fund. VOO and IVV charge just 0.03% per year. SPY charges slightly more at 0.09%. To put that expense ratio in real numbers, on a $10,000 investment, a 0.03% fee costs you about $3 per year. That's it. Compare that to actively managed mutual funds that often charge 1% or more. That's $100 a year on the same amount, and historically most of them still underperform the S&P 500 anyway. Actually buying it is remarkably simple. Open a free brokerage account with Fidelity, Vanguard, or Schwab. Search for the ticker symbol VOO, SPY, or IVV. Enter how much money you want to invest and hit buy. The entire process takes less than 10 minutes, and many brokerages now let you buy fractional shares starting with as little as $1. Here's great news for beginners. Even though one full share of VOO costs several $100s, most modern brokerages allow you to buy fractional shares. This means you can start investing in the S&P 500 with as little as $1, $5, or $10. There is no minimum barrier to entry anymore. The best strategy is to set up automatic recurring investments. Most brokerages let you schedule automatic monthly purchases. Set it once, and every month your chosen amount gets invested into the S&P 500 automatically without you having to think about it, remember it, or emotionally react to market news. Quick recap before we move on. The S&P 500 is the 500 largest U.S. companies. You invest in it through ETFs like VOO, SPY, or IVV. And thanks to fractional shares, literally anyone can start with just a few dollars. Now, let's talk about why this actually matters for your long-term wealth. Let's look at the actual history. Since 1926, the S&P 500 has weathered the Great Depression, World War II, the 2008 financial crisis, and the COVID crash. Through every single one of these events, it has always recovered and gone on to reach new all-time highs. Not most of the time, every single time. The historical average annual return of the S&P 500 is approximately 10% per year, or about 7% when adjusted for inflation. Compare that to a typical savings account earning less than 1%, or bonds earning 3 to 4%. Over decades, that difference compounds into a genuinely life-changing gap. Here's where compound growth becomes almost unbelievable. A single $10,000 investment left in the S&P 500 for 10 years grows to roughly $26,000. Over 20 years, roughly $67,000. Over 30 years, roughly $175,000. Same original investment. The only difference is time. And time is the one advantage everyone watching this video actually has. Let's slow down on the $100 a month example because the growth is not linear. It accelerates. After 10 years, you'd have about $20,000. After 20 years, $76,000. After 30 years, $220,000. After 40 years, approximately $584,000. Notice how much faster the growth happens in the final decade compared to the first. That's compound interest doing the heavy lifting. Now imagine you increase your monthly contribution to $300 instead of $100. Same 40 years, same 10% average return. Your final total isn't just a little higher. It triples to approximately $1.75 million. This is why increasing your contribution rate even slightly, especially early in your career, has such an enormous long-term impact. Warren Buffett has said directly, quote, "A low-cost index fund is the most sensible equity investment for the vast majority of investors." This is coming from a man who has personally beaten the market through individual stock picking for over 60 years. Even he recommends the simple index fund approach for almost everyone else. In 2008, Buffett made a famous $1 million bet that a simple S&P 500 index fund would outperform a basket of expensive hedge funds over 10 years. The result? The hedge funds returned about 36% total. The S&P 500 index fund returned about 125%. Professional stock pickers, with all their resources, lost badly to the simple, boring index fund. This isn't a one-time fluke. Multiple long-term studies show that over any 15-year period, approximately 90% of actively managed mutual funds failed to beat the S&P 500. 9 out of 10 professional fund managers with teams of analysts and years of experience still can't consistently beat this simple index. That should tell you everything you need to know. Why is beating the index so difficult? Active fund managers face constant headwinds, trading fees, higher taxes from frequent buying and selling, and management fees that eat into returns. Meanwhile, the index fund does almost nothing. It just holds the same 500 companies, rebalances occasionally, and charges almost no fees. Sometimes doing less really does produce more. There's also a psychological advantage most people overlook. Picking individual stocks requires constant attention, creates emotional stress during downturns, and often leads to panic selling at exactly the wrong time. Index fund investing removes almost all of that emotional burden. You set it up once and largely leave it alone. Study after study shows that investors who try to time the market, jumping in and out based on news and emotions, consistently underperform those who simply invest a fixed amount every single month, regardless of what's happening in the headlines. Consistency beats cleverness in investing almost every single time. The strategy of investing the same amount every month, regardless of price, is called dollar cost averaging. When prices are low, your fixed $100 buys more shares. When prices are high, it buys fewer shares. Over time, this naturally smooths out your average purchase price and removes the impossible task of trying to guess the perfect time to buy. What about crashes? Yes, they happen, and they will happen again. But here's the historical pattern. After the 2008 crash, the S&P 500 fully recovered within about 4 years and went on to new highs. After the 2020 COVID crash, it recovered in less than 6 months. If your investing timeline is 10, 20, or 30 years, these crashes become minor bumps on an otherwise upward road. The single biggest investing mistake people make during a crash is selling. When you sell during a downturn, you lock in your losses permanently. The investors who do best are the ones who simply keep their existing investments in place. Or, even better, continue buying at the lower, discounted prices during the dip. Here's a statistic that should end any debate about market timing forever. If you had stayed fully invested in the S&P 500 for the past 20 years, you'd have earned the full historical average return. But if you had simply missed the 10 best trading days during that same period, just 10 days out of thousands, your total return would have been cut nearly in half. Here's the honest truth about the S&P 500 strategy. The math is simple. The knowledge required is minimal. The actual challenge is patience. Staying invested through market crashes, ignoring scary headlines, and resisting the urge to try something smarter. This strategy isn't hard because it's complicated. It's hard because it requires discipline. Quick recap. The historical average return is around 10% per year. 90% of professional fund managers fail to beat this simple index over the long run. Warren Buffett himself personally recommends it, and time in the market consistently beats trying to time the market. Now let's talk about common myths and mistakes. Let's debunk some common myths. Myth number 1. You need a lot of money to start investing in the S&P 500. Completely false. With fractional shares available on nearly every major brokerage app today, you can start with as little as $1. The barrier to entry that existed a decade ago simply doesn't exist anymore. Myth number 2. The market is too risky right now. I should wait for a better time. Here's the problem. People have said this exact sentence every single year since 1926. If you had waited for the perfect time, at any point in market history, you would have missed decades of growth. There is no perfect time. There is only time in the market. Myth number 3. I should pick individual stocks for bigger returns. Sure, you might occasionally get lucky and pick the next big winner. But statistically, most individual investors who pick their own stocks underperform the S&P 500 over the long run, largely due to emotional decisions and poor timing. The index fund removes the gambling and replaces it with a proven, boring, reliable path. Myth number 4. Index funds are just for beginners who don't know better. Wrong. Many sophisticated institutional investors, pension funds, and even professional fund managers hold significant portions of their own personal wealth in simple S&P 500 index funds. Simplicity and effectiveness are not mutually exclusive. Common mistake number 1. Waiting for the right time to start. The right time was actually whenever you first thought about it. Every month you delay is a month of potential compound growth you can never get back. The S&P 500 doesn't wait for you to feel ready. Common mistake number 2. Checking your investment app obsessively. Daily market fluctuations are normal and mean almost nothing over a 20 or 30-year timeline. Checking constantly only creates unnecessary anxiety and increases the temptation to make emotional decisions. Check monthly or quarterly at most. Common mistake number 3. Selling during a market downturn. This is the single most damaging mistake in long-term investing. You transform a temporary paper loss into a permanent real loss, and you typically miss the recovery that follows shortly after. If you don't need the money for years, a downturn should never trigger a sale. Common mistake number 4. Relying on willpower instead of automation. If investing requires you to remember and manually transfer money every month, you will eventually skip months. Setting up automatic recurring transfers removes willpower from the equation entirely and ensures perfect consistency. Your simple action plan. Step 1. Open a brokerage account with Fidelity, Vanguard, or Schwab, all completely free. Step 2. Search the ticker VOO, SPY, or IVV. Step 3. Set up an automatic monthly investment for whatever amount fits your budget. Step 4. Do nothing else for the next 20 to 30 years. That's genuinely the entire strategy. This week's single action. If you don't already have a brokerage account, open one today. It takes about 10 minutes on Fidelity, Vanguard, or Schwab. You don't need to invest a large amount immediately. Just get the account open so the barrier to starting is completely removed. Here's the final perspective I want to leave you with. Investing doesn't need to be exciting to be effective. In fact, the most reliable, most historically proven wealth-building strategy available to regular people is often the most boring one. The S&P 500 won't make headlines. It will just quietly build your wealth over decades. You don't need to be a genius investor to build real wealth. You need a simple strategy, consistency, and enough time to let it work. The S&P 500 gives you all three. Everything else is optional. Thank you for spending time understanding one of the most important building blocks of long-term wealth. This single concept alone can change the entire trajectory of your financial life. If this video gave you clarity on one of the most important investing concepts out there, hit like and subscribe. I break down exactly how money works every single week, completely free. Coming up next, the 50-30-20 rule, the simplest budgeting framework that tells you exactly how much to invest into things like the S&P 500 every single month. It pairs perfectly with everything we just covered. Bonus fact to close out. If you had invested just $10,000 in the S&P 500 back in 1990 and left it completely untouched, it would be worth over $220,000 today. No trading, no stock picking, just patience. A few more quick facts. The S&P 500 was created in 1957. It represents roughly 80% of the total value of the U.S. stock market. VOO alone manages over $400 billion in assets, and many employer 401k plans already include an S&P 500 index option. Check yours today. Quick action item. If you have a 401k through your employer, log in right now and check your fund options. There is very likely an S&P 500 index fund option already available, often listed as an S&P 500 index fund or with a similar name. This might already be sitting right there, waiting for you to use it properly. The financial industry often wants you to believe that investing is complicated, that you need special expertise or exclusive access. The S&P 500 proves the opposite. Sometimes the simplest, most boring path really is the most effective one. The most common question I expect, but what about individual stocks for bigger gains? Fair question. If you enjoy researching companies, you can absolutely allocate a small portion, say 5 to 10%, toward individual stock picks as a supplement. But the S&P 500 should remain the reliable core foundation of your portfolio, not an afterthought. The real secret behind the S&P 500's success as an investment isn't hidden anywhere. It's written right there on this scroll. Consistency, time, and simplicity. No secret formula, no insider information, just 3 principles anyone can apply starting today. Today's entire video in 3 sentences. 1. The S&P 500 is the 500 largest U.S. companies, and you invest through ETFs like VOO. 2. It averages about 10% annual returns and beats 90% of professional fund managers. 3. Automate your contributions and stay invested for decades. I'm Jax, and I'll see you next week for the 50-30-20 rule. Until then, go open that brokerage account. Future you is counting on the you of today. Remember this, the best time to start investing in the S&P 500 was yesterday. The second best time is today. Don't let this be another video you watch and forget.